going to cover is we're going to talk about the basics of depreciation. What is depreciation and how does it work? We'll show you how to add assets. We'll talk about the general depreciation. Then we'll go into the vehicle depreciation and show you how you can allocate vehicle mileage between two different schedules in the program. And then we'll recap and have some time for some questions. So what is depreciation? Depreciation is an income tax deduction, and what it allows you to do is recover the cost or the basis of income-producing property. So you've got to be able to say that you're using this property in a business. It's an annual allowance for the wear and tear, deterioration of the property. It begins when the taxpayer places the property in service, and remember, it needs to be placed in service in a trade or a business that produces income. And it ceases to be depreciable once the basis is fully recovered or the taxpayer retires it from service, takes it out of service, whichever comes first. So depreciable assets, most types of tangible property, such as buildings, vehicles, furniture, equipment, computers, they're all depreciable. Land is not depreciable. There's certain intangible properties, copyrights, computer software, patents, and they are also depreciable. There are certain rules that do apply to depreciation. First of all, the taxpayer must own the property. It can't be rented property, leased property. They must own it. The taxpayer must use this property in producing income. The taxpayer uses the property, if they use it for both business and personal, they can only deduct the depreciation on the business use of the property. It must have a useful life of more than 1 year. The tax preparer needs to identify several things in order to ensure the depreciation of the property, and these include the method that they're going to use to depreciate the property, the basis of the property or the cost of the property, the class life of the asset, whether it's considered to be listed property or not. If they'll be able to expense any portion of that, that means write off the entire amount, and if they qualify for any bonus first-year depreciation. So a simplified method or example here of depreciation, say you purchased a computer and the cost of the computer is $1,500. So you're going to depreciate the computer over a 3-year period, which shows that you will get $500 a year. That goes against the income and it reduces the income. In our program, in order to depreciate, you first must have a correlating form or schedule that supports the depreciation. For example, we're talking about the Schedule C, the Schedule E, the Schedule F, or the 2106. So what I'd like to do now is switch screens and show you in the program how depreciation works. I've entered a very basic return here, a very simple return, added a Schedule C and a Schedule E. Remember, I told you you must have the supporting form in order to do the depreciation. If you can select from an existing form, or you can simply go and add a form by clicking the Add Form button or using Alt-A to add a form. If you know the name of the form, simply enter it here and it will bring it up for you. Right now what I've got is a Schedule C and a Schedule E. We're going to use those for our depreciation. In order to start depreciation, you see right up here under General, we've got Depreciation. If you click on this, it says that I have a Schedule E and a Schedule C that are attached to here that the depreciation can go to. So what I need to know 3 basic pieces of information in order to start depreciation. I need to know the type of asset that it is, the date that it's placed in service, and the cost of the asset. So let's open up our landscaper. Remember, I told you you needed to know 3 pieces of information. After you click the New Asset button, a new screen will come up that will say, what is the name of the asset? What are we depreciating? In this case, let's go ahead and depreciate a desk that he purchased for his business. It was placed in service 1/1/2015. What I need to do now is I need to look below at this table and find the class life for this this asset. So if I look down, I can see furniture and fixtures. Once I click on this tab, it's telling me that it's a 7-year property. The method I'm using is the 200 dB, and it's a half-year convention. So once I open that, it's going to bring me to a new screen, which will just show the general depreciation. And if that's all I have is just depreciation, all I have to do is enter a cost basis and click the Close tab, and it's going to calculate the depreciation for me. So let's just say I've got $500 in this desk, and at that point, all I would have to do is click Close, and it will calculate the depreciation. So let's take a look at this screen for just a minute. There's other items on this screen which you might need as far as depreciation goes. To delete an asset, you would use this tab here. If you've sold the asset, it's this tab. If you've got a casualty or theft, or if you take the asset out of service, you're going to click this tab. If I click on the depreciation tab, I see I've got other items now that I can make adjustments on. So I can make adjustments on these that are for prior year depreciation or current year depreciation, and I can do that at either the state or the federal level. So any advanced depreciation would be done on this tab. So I've entered my $500 for my desk, and as I click Close, it's going to take me to well, I guess I could call this a table. I'm going to build this table down. All my assets are going to be added to here. Let's add a chair to here. Clicking New Asset. We'll name it as a chair. Placed in service. Furniture and fixtures. And we got a $700 chair. We're done with that depreciation. It's already calculated it for me. Very simple, very easy. What happens now is this information will carry back to my Schedule C. Since that's where I had it added to, it will carry back to the Schedule C. If I close here, open up my Schedule C, I'll see where the depreciation is carried over here. Very simple, very easy to do depreciation in our program. So let's talk about vehicle depreciation. If I've just got a Schedule C that I'm taking mileage on, I'm able to go to the Part 4 of the Schedule C and enter in that information on information for vehicles. It's asking me the date placed in service and the total business miles. I do need to answer the questions. Once I've entered this information, it will carry back to the front of the Schedule C. Now, if I've got two different income producing schedules, in this case I've got a Schedule C and a Schedule E, and I've used my vehicle on both of these, you're able to calculate the automobile expense, and it will carry to each one for you. In order to do that, you're going to click on Depreciation, where you see Vehicle Allocation, open up that tab, enter your new asset, and I'll say it's a Ford Focus, and as you look at this, you'll see that I've got a much smaller list to pick from. So I'm going to say that this is a gas-powered automobile under 6,000 pounds, which is going to allow me to depreciate it over a 5-year period. So once I click on that and say, okay, it's going to ask me the cost of the vehicle. Once I enter that cost, you'll see I've got some questions down here that I need to answer. Was the vehicle available for personal use? Was it by 5% owner? Is the vehicle available for personal use? Is another vehicle available for personal use? And do I own the vehicle? I have the option that I can either force actual expenses or force the standard mileage. I'm not going to force either of them on this. And then you also see that there's a question that asks about if acres or acres was used in a previous year. Because this was placed in service in 2015, I don't have an option to answer that question. Once I complete that, I'm going to go to this tab over here that says mileage expense. When I open up the tab that says mileage expense, I'm starting at the top of the form and it's asking me my total vehicle miles. I'm going to say I drove 15,000 miles this year. And how many of those were commuting miles? I had 5,000 that I commuted back and forth with an average daily commute of 5 miles. Then you see I've got my properties down here. I've got my Schedule C property and I've got my Schedule E property. I'm able now to say that I've driven, let's say, 4,000 miles for my landscaping business. For my Schedule E property, I've driven 500 miles. I can put in my actual expenses here. And I answer these questions. Do I have evidence to support this deduction? Yes, I do. And is the evidence written? Yes, it is. So once I've done that, and it's going to split between these two, and I've entered in my actual expenses, Crosslake is going to figure what the greater deduction is, and will take the greater deduction to the assigned schedule, either the Schedule C or the Schedule E. So once I close here, I can go back to my Schedule C and I can see that the mileage has already been carried over to line 9. As I open up my Schedule E, I can see that the mileage has been carried over to line 6A. Everything is automatically calculated for me. So as a recap, in order to depreciate an item in the Crosslink program, I must have a supporting schedule or form, which would be my Schedule C or my Schedule E. The ones that you will see with depreciation will be your Schedule C, your Schedule E, your Schedule F, and your 2106. Now, Crosslink will simplify depreciation into 3 easy steps. You're going to select the type of asset, enter the date that it's placed in service, and then enter the cost. The calculations will determine the appropriate amount to use for your vehicle expenses, whether you're using your standard mileage or your actual expenses, and the program will carry the largest deduction for you.